but a lot of what happens in finance is mechanical, and there's multiple things happening at once. For example, Michael Green talks a lot about that passive mechanical action that's happening. And you've been emphasizing for a while this carry trade that was presenting risk to the market. And one of the things I focus on is kind of the structure of the dollar system, which is to say that most currencies they trade in terms of like relative interest rate differentials, and they trade in terms of like current account balances. So if a country's weak in one of those areas or both, it'll generally the currency will weaken until an equilibrium is found. The United States is different because as the global reserve currency, it's the largest, most liquid currency, deepest capital markets, and so our currency has this extra monetary premium on top of it because there's so many entities around the world wanting to have dollar-denominated assets. And so that makes our currency kind of like stronger than it would be based on those normal metrics. So we have stronger import power, weaker export competitiveness. So we run these structural trade deficits and put lots of dollars out into the world. And all these countries, they become, a lot of them become creditor nations. They take their dollars and then they reinvest them into U.S. capital markets. So they own more of our debt, they own more of our stocks, they own more of our private businesses and our real estate. And over the past several decades, everyone's kind of on one side of the boat. There's so much global capital stuffed into U.S. markets. And then a component of that, like a subcomponent of that much larger thing, is the yen carry trade, which is basically if you can borrow currency at near zero interest rates and you can invest it in a currency or bonds or equities of a higher yielding currency, especially when those higher rates also help strengthen that currency relative to the zero yielding one, people will do it. So people borrowed a lot of yen, and then they use it to buy interest-bearing dollar type assets and equities and all that. And now we're seeing somewhat of a reversal, which is to say that as Japan takes fairly minimal actions to defend its currency from disorderly devaluation, there's a sharp move in the other direction, and so that caught a lot of those investors off sides because it's a fairly leveraged trade. It's kind of perceived as being risk-free because the yen only goes down. But when there's a combination of sharp interventions, like the Bank of Japan and Japan's government getting involved to defend the currency with basically asset sales, or in terms of a little bit harder interest rate policy compared to what they've been doing before, it can sharply unwind those things. So a lot of what happens in global markets is a result of these kind of structural mechanical issues, many of which has built up over a long period of time.
The financial landscape is shifting dramatically as Japan makes pivotal moves that could exacerbate the looming US recession. Data from the Bank for International Settlements reveals that Japan's cross-border lending, standing at a staggering 250 trillion yen, approximately $1.7 trillion, plays a crucial role in this complex financial ecosystem. As Japan takes action to defend its currency from disorderly devaluation, the ripple effects are being felt across global markets, catching investors off guard. The unwinding of the yen carry trade, which once seemed like a risk-free strategy, is more than just an isolated event. It's a catalyst that could deepen economic challenges in the United States, highlighting the vulnerabilities of a financial system heavily reliant on borrowed yen to fund investments in higher-yielding dollar assets. Lyn Alden explains how these developments are part of a broader financial narrative, where US markets already inundated with global capital face increasing pressure from these currency shifts. As the yen strengthens, the reversal of the carry trade could lead to significant capital outflows from US assets, threatening to weaken the dollar's dominance and worsen recessionary trends. With $13 trillion in dollar-denominated debt held outside the US, primarily in developing nations, the strengthening dollar is already squeezing economies worldwide, prompting a global rebalancing.
So it's part of it. Generally speaking, U.S. tech stocks trade at higher valuations than foreign tech stocks as well. So some of it is sector component, and some of it is even sector by sector were more expensive. In addition, it feeds off itself. So for example, by attracting so much capital to U.S. equity markets, it makes the equities more valuable, and then they can issue a lot of shares and pay their employees, and it doesn't really devalue the shares because it's such a strong bid. So they actually get a competitive advantage because so much capital wants to flow into them. So then you can go back and say, well, how much of the success was because of their internal fundamentals? A lot of it was, versus they had this extra component of like automatic buying that gave them even further entrenched advantage. It's basically lower cost of capital than any other company in the world. Those kind of like Mag 7 type stocks. And this a lot of the tech in this era, that period you mentioned, was social media, and so English being kind of like the broadest spoken language, not actually the top by number in terms of the world, but the most spread out language spoken is English. It's basically the global language of business and kind of international communications. So the United States had a pretty strong advantage in the social media space, in addition to our focus on venture as a kind of like just entrepreneurship in general. So a lot of it is that. In addition, these loops tend to feed on themselves. So for example, the world has something like $13 trillion in dollar-denominated debt. Ironically, most of it's not owed to the U.S. Most of it's owed to other countries. Like China will lend dollars to country XYZ, for example, or France will lend dollars to country XYZ. And so when the dollar strengthens and capital's flowing into the U.S., it squeezes all those countries that have dollar-denominated debt in a similar way that yen carry traders just got squeezed by the yen strengthening a little bit. But imagine this more pervasively. Companies and governments around the world, mostly in developing countries, holding dollar-denominated debt, and so they do poorly in that stronger dollar environment. So capital wants to leave them, and it wants to go into the U.S., which even further exacerbates that. It even strengthens the dollar further and further suppresses them. And that feeds on itself for a very long time. When you look back in cycles of U.S. versus foreign markets, generally that kind of engine can go on for 10, 15 years, and then it kind of rolls back in the other direction. Where, for example, after the dot-com bust, the U.S. cut interest rates, and the dollar weakened, and capital started to leave the overvalued United States market, start to go to all these beaten down emerging markets that got wrecked by the Asian financial crisis, and just kind of broadly had an issue from strong dollar, and it starts flowing into there, flowing out of the dollar, and then that whole engine goes in reverse, where because now the dollar is weakening, those countries that owe dollars are getting a reprieve on their liabilities. So they're getting like a liquidity benefit. Their cash flows relative to their liabilities are improving, and then more capital sees that and says, "Well, I want to invest there. It's cheap. It's beaten down. It's coming out stronger," and you get that flywheel in the other direction. And so that's some of the mechanical aspects that can happen here over fairly long time frames. Well, the number matters because it gives you a relative scale of what we're talking about. If something's 500 billion versus 30 trillion or whatever, that's a meaningful thing in terms of existential kind of impacts on markets. How big are we talking here compared to global fund flows? That's a number I've seen posted multiple times. Like, I DM'd because you mentioned it. And this meme, I was actually watching a podcast, and one of my friends mentioned 20 trillion on the podcast. I'm like, where are people getting this number from? It's like it's always the same number. So I posted the meme. I'm not calling anyone out with it. It's kind of like it's come up a number of times. I dug into it. Below that meme, for example, I linked to the Wall Street Journal that shows data from the Bank for International Settlements and other sources that they estimated somewhere around 250 trillion yen in cross-border lending, which is something like 1.7 trillion at current exchange rates, which is about an order of magnitude smaller, but that's still massive, right? So it doesn't mean that the carry trade is not an issue. It doesn't mean it's not. It's obviously been an issue in recent days. It just kind of helps put scale on what we're talking about here. And then it's like, well, if people are measuring it differently, I want to know how they're measuring it. The first way I realized that the 20 trillion can't be literally accurate is because when you lend, like when a bank lends currency, it creates more of that currency in the broad sense. Lending creates deposits, and that 20 trillion figure is bigger than all of Japan's broad money supply. And of course, only a part of the money supply is used for things like this. Most of it's actually just like cash balances of corporations, households, things like that. So my initial assumption was that it was probably around 2 trillion. And then so when I found the Wall Street Journal piece, I actually looked at some of the numbers, and they're saying 1.7. And even then, like, not all of those foreign, like, cross-border yen loans are for carry trades per se. Sometimes they do a little bit of actual business funding with yen. But yeah, if we assume most of it is carry trade, that gives us like a roughly idea of how big it is, which is quite large. And anything measured in the trillions, can obviously impact global markets. Right. So, I mean, one fact is that the Treasury Department has initiated Treasury buybacks to try to address the liquidity problems in older bonds. So they basically will, use proceeds from newer bonds on the run securities to buy off the run securities from the market. So basically, if you have a fresh 10-year Treasury, that's a super liquid asset. But if you held it for 6 months and now it's a Treasury that matures in 9.5 years, that's kind of an awkward asset compared to like this brand fresh new like 10-year Treasury. And so that 9.5 year one is now considered off the run. It's less liquid, and so the Treasury will buy those back. They're actually trying to improve liquidity in what is supposed to be one of the deepest, most liquid markets in the world, which ironically is quantifiably less so than it used to be. If you look at, for example, trading volume relative to market size, it's been on a steady downtrend. So I don't think that they're taking actions to make things more illiquid or problematic. In addition, even though during like asset price crises, it is true that bond yields normally go down, but it doesn't necessarily mean that a lot of money structurally flows into bonds. That price is set around the margins. So a fairly small percentage of capital can move into a fairly large market and affect the price pretty significantly on that particular day or week. The COVID crash of 2020 was interesting because while the crash was happening, bond yields were going down, as one would expect. But then at the very bottom of it, it got so illiquid. And we go back to those dollar-denominated debts that I mentioned before. There are all these entities around the world that had to service their debts. They needed dollars, so some of them just outright had to force sell treasuries to get dollars. And so you actually had the treasury market go illiquid. Yields started to spike from that low level, and that's when the Fed had to come in and buy like $1 trillion worth of treasuries with new base dollars in a week, and then keep buying for a while. So in addition, if they want to save the treasury market, the size of the deficit matters. And if asset prices go down broadly, in the United States in particular, our tax receipts are very correlated to asset prices. And that's in large part because we've structured our tax differently. So, starting in the 90s, there are all these bills basically saying that certain types of stock-based compensation are given better tax treatment than like cash-based compensation. We also just have more wealth concentration in general. So asset owners, as asset prices go down, they have less capital against taxes. They spend less. Their executives are getting less compensation, and so our tax receipts are very heavily correlated with that. So if we hurt the stock market, ironically that widens our deficit, which means more bonds coming to market. Even if we could also have incrementally more demand for those bonds as a safe haven asset, but it's basically a very complicated relationship. So that's why I wouldn't purposely take that conspiratorial view, even though I think there are conspiracies I agree with, but I think this one is probably just too many investors on one side of the trade, and Japan trying around the margins to protect its currency.